most middle market business owners think they know more about the business than anybody else. The single most important or valuable asset that private equity uses to drive value is essentially reverse engineering. When they buy an investment, they create what's called an investment thesis. They essentially have future state business in 5 years. They know what it's going to look like. They have an idea of who they're going to sell it to. They have an idea of what they're going to emphasize, what they're selling, and they work backwards and reverse engineer their way and holding themselves accountable to building that business for the ultimate exit.
Welcome to the Strategy at Scale podcast, brought to you by Scaling Up Outthinker and Growth Institute. Our mission is to cut through the sea of contradictory business advice to get to what actually works. We interview entrepreneurs and business builders who have successfully scaled companies across industries to extract proven, high-impact strategies to scale the value of whatever you are building in this world. You just heard from David McCombie. David's career path from a lawyer to McKinsey consultant, to investment banker, and ultimately to founding McCombie Group is a fascinating study in navigating complex business transactions and understanding the value of your business. He is the author of Selling Your Business with Confidence, a practical playbook for mid-market owners. Over the last 15 years, David has advised mid-market business owners on selling their companies, structuring deals, and maximizing valuation, all while ensuring that they exit on their own terms. I first got to know about David because, like me, he started his career at McKinsey. One of the advisors of his firm was actually my first partner at the firm. And a friend of mine later moved back down to Miami to work for the McCombie Group. So even before we met, I had a strong sense that he was someone whose insights on strategy, private equity, and M&A were worth paying attention to. David's expertise in M&A and private equity has made him a trusted advisor to family offices, private investors, and entrepreneurs looking to scale and sell their businesses. What struck me most about this conversation is how David's experience highlights one of the biggest strategic decisions any business owner faces. What is your exit strategy, and how do you maximize the value of your business when it comes time to sell? In this episode, David and I discuss how business owners can structure their companies to be more valuable at the time of sale, why your business's revenue model determines how potential buyers will value it, the biggest mistakes entrepreneurs make when trying to sell and how to avoid them, how private equity firms reverse engineer their exit strategies from day one, and why entrepreneurs should do the same. David's insights will fundamentally change how you think about long-term value creation, deal structuring, and positioning your company for a high-value exit. Let's dive in with David McCombie. Great to have you on the podcast. Thank you so much for taking the time to talk with us. We have already given the listeners a little bit of background, but maybe just give us like kind of a high level overview of your career before you decided to start McCombie Group.
So before I decided to start McCombie Group, first of all, I'm a lawyer by training. I ended up doing investment banking very briefly. But went after law school to McKinsey and Company, where I started my career. And, I think it was a great training ground to get exposed to lots of different industries, lots of different functions and challenges. And perhaps most importantly, teaching me to have the confidence that I can figure things out. Ultimately, what I've realized as I've taken my entrepreneurial journey is there is no playbook. If there was, it generally is not going to be very helpful because everything is so contextual. And, that ability to say, hey, look, I can systematically kind of work through this and figure out the best path forward, combined with, I think a great work ethic that really was, cultivated in the consulting firm, really helped set me up foundationally for success. And, even though I do M&A advisory today, since it's focused in the middle market, in a lot of ways, it's much closer to consulting than it is to, the Wall Street investment banking that I did at a large bulge bracket firm.
Yeah. So which office were you in at McKinsey?
So I was based in Miami, where I was born and raised, and where I am today.
Yeah. Yeah. I spent a few years, but we didn't overlap in the Miami office as well. So what I hear you saying is, and I guess Miami is also a great place to do that because the diversity of the work if you are in Chicago, you're going to be doing a lot of CPG. If you're going to New York, you'll be doing a lot of financial services. Miami, it probably expose you to a more diverse set of industries. And what I heard you say, I'm just going to re-paraphrase it, but see if I'm getting this right. Kind of what you learned was both the confidence that you could solve a problem and some approaches to solving the problem, which you can then apply
100%.
to lots of just perfect. Great. So then tell us about, if you don't mind, the beginning of your decision to start the firm, and what your hypothesis was of how the firm would make money and be structured, and what it ended up being.
Yeah. So, in a lot of ways, the firm was accidental. I left McKinsey in 2010. I actually lost my job at that point. It was a great financial crisis. And I had a number of different hypotheses of what I wanted to do initially. I wanted to try to go as a private equity investor and buy failed banks from the FDIC. And so that's actually how I initially started. And went and connected with a couple of different operators and ended up encountering some really interesting businesses, but we never were able to pull the trigger and get it over the goal line. But that accidentally launched what became my business, McCombie Group, which at this point is almost 15 years ago. What I realized was from those relationships, at least of the capital sources, which were primarily family offices for that transaction, that there was a deep desire to have support for the private equity investments. So I initially started off, in a lot of ways, it was more of a job than a company, helping them assess, monitor, restructure different private investments that they were, encountering. Remember, this was in the aftermath of the financial crisis, and really exposed me to a lot of different things and opportunities. And so ultimately, over time, I said, hey, I see you are looking at a lot of these deals, some of which I, don't really think are very compelling. If I were to find you deals, would you back me? And ultimately, some said yes. And we can talk more about, when the actual deals occurred, how many of those were actually there to write the check. That's a different story. But that basically started my business. And so for the first, call it, 6 or 7 years, it was primarily focused in that private equity realm with family offices, either as an advisor or I started finding a couple deals and essentially serving as a general partner in those transactions. Over the past 6 years, we essentially have pivoted the business to a more zoomed out a little bit and increased our scope from not just private equity but also M&A advisory. So we will selectively do different private equity investments, but we made that shift for some strategic, but also some personal, reason.
Just for our listeners, explain what's the difference between private equity and M&A advisory.
Yeah, so basically an M&A advisor is going to represent the seller in approaching a number of different buyers, essentially running an RFP and using that competitive process to get them the best price, fit, and terms. The private equity investor is the actual entity that is buying the business and makes money based upon the success of the business that they're buying and the changes that they're implementing. And so most people start in an M&A advisory and shift to private equity, and I've actually made in a lot of ways the opposite journey. And it came about for a few reasons. One was I've come to terms and I realized that I'm probably more conservative and risk averse than most. So for every deal that I thought was very exciting and of high value for me to invest in, I was basically passing on 19 deals that could have been monetized by an institutional private equity source that would have looked at it, perhaps more aggressively, right, and had a higher risk tolerance. And with a portfolio effect, that may be the more rational approach. But I think you also need to know thyself and kind of really see where you shine. The other effects that came about, with that was, COVID, started. And so the combination of the two, one, I felt like the advisory side, there was a lot of opportunity. Ultimately my skill set was very well aligned with it to be able to apply the same skills I used as a buyer, as a seller. And in fact, I think I'm much better as a representative because of that. And so there's that aspect, but I also didn't want to travel all the time. As a private equity investor, you have to, you're a fiduciary and you basically need to look nationally to find the best possible deals. And I looked, particularly at the beginning of COVID in terms of, the restrictions on travel, but also, I was starting my family and I decided, I'd rather be able to do something that I can be very deep within the community. I don't necessarily need to travel, but I can still do what I love. And so, that's really what launched the advisory business. And in a lot of ways, despite us being 15 years old, that's really when our business, took off. In some ways, I look back and I say, I wish I would have done this all the way at the beginning, right? But, you learn your lessons. You have different perspectives and opinions of what works, and sometimes they do, and other times they don't. And so, there's a whole element of, when you kind of see that traction and fit, it's amazing how much easier it is than when you're basically trying to swim upstream and, convincing somebody of something of which it's just very difficult for them to understand or for them to want to accept.
Yeah. So what I'm going to paraphrase here. You were working for backers that are family offices, and they wanted you because of that role. You had to travel all around the country to look for the best deals. And you found a lot of deals that you didn't feel comfortable backing, but someone else might. And now that you are serving companies that want to sell themselves or want investors, you don't need to look all around the country. You can kind of focus in closer to home, which also gives you more of the kind of the personal life situation that you wanted.
100%. Because, ultimately, you could be an industry specialist. And we do have different industries of which our team has, more experience than others. But we've decided to be very deep geographic specialists to really understand the market. We have a fully bilingual team, which is very important with a lot of different Miami businesses. And, there's also just what's your comparative advantage? I grew up here. I know a lot of people here. And, for me, it was also very important that my professional and my personal lives were symbiotic. I want to be able to sit on boards. I want to be able to participate in different things, put aside kind of the financial and professional, objectives. And so it was something that not only made strategic sense, but also made, I guess, strategic sense within my personal objectives that I had for my life and my family's life.
I like it. Who was the first company that you decided to act as an advisor to?
It's a good question. Ultimately, it was a smaller business than what we normally take, but it was another private equity investor, and he said, "Hey, I think it was his uncle-in-law or something like that, has a nice little business. I don't really trust other investment bankers. Can you help him?" And so I never really had considered it, but I said, sure. I know how to do M&A transactions. I do a lot of them. Ultimately it really opened up my eyes that there was, as I went through it, it was something A, I enjoyed. B, I felt a strong sense of fulfillment and purpose. Here's somebody that without me would have done dramatically, had a dramatically different outcome. Just as an aside, when you work in a big Wall Street firm, every client probably came from an MBA program. Most of the counterparts were former investment bankers. The result that they would achieve is not that much different with or without us. We were a CYA asset for them. But for the smaller business owners, I developed a relationship with them. I knew about them. I knew about their family. I knew about what the money meant for them and retirement meant for them. And so it's something which, in some ways was accidental, but that led to me saying, hey, look, there's actually something here that I should think about more broadly. And, when I then looked at it from a more strategic standpoint and said, okay, who are the other people within the region that are providing these services? I felt like, that there was a pretty big vacuum that I could take advantage of. And, thankfully it's worked out all right. But without those challenges or lack of traction in some of my prior, efforts, I probably would not have, considered it and, would be in a totally different place today.
Yeah. So then outside of managing the process, which I totally get, you've done it many, many times.
Yep.
This entrepreneur has never done it, or maybe done it once. So you bring knowledge on how to run the process and get the best situation for them. But outside of that, what other kinds of things do you find that entrepreneurs need help with? I'm thinking things about, making decisions to increase the value, to make sure that it's a sellable business.
Yeah. So, sale readiness and maximizing the value of the business is absolutely something that we do, opine on and help. For us, in a lot of ways, that's more to relationship build and is more of a loss leader to develop that relationship, because, one of the observations of moving into the M&A advisory world was it is much easier to be fairly compensated when there's a transaction and money changes hands than when there's not, right? And particularly in South Florida, where I feel like it's not really generally a consulting world where people, most middle market business owners think they know more about the business than anybody else, and are generally not big advocates of consulting.
Yeah, like their willingness to pay for consulting is low.
Correct. But when you can basically be the gateway to help them get a large payout, it's something of which, standard market rates that would occur in, New York or any other, market are much more, achievable. But, one of the things, when you talk about the process, we can talk, any aspect of that, but I think it's important to also set the stage a little bit of what truly happens with a middle market business owner. Because unlike when I was in Wall Street, where all our clients were essentially principals, they're an employee of Google, they're an employee of Exxon or whatever, a middle market business owner essentially is both economically and emotionally invested in the business. And so you think about the cocktail of emotions that really can impact somebody's, decision-making, right? So put aside the fact that, they're experts in running their business, but they really have no experience in the actual process of selling it, right? But there's a whole other, overlay of it, which is, the whole sales process is an extremely emotionally exhausting process for most business owners, right? First and foremost, it's a large amount of time. They have to work their full-time job managing the business, but they also have generally an equal amount of time on the transaction, even with an advisor, right? You're basically keeping in front of all of your closest friends and colleagues a secret, right? Which is very emotionally, tolling. Particularly once you go further in the due diligence, it is a very scrutinizing transaction. So there's a lot of defensiveness that gets arisen.
Yeah, a lot of questions that they don't normally get asked.
100%. And so, you put all those different things together and basically, looking at cognitive biases or whatever, the conditions are not ripe for somebody to be making, the best financial and life decisions, because, sometimes it's not just about what's the money, but who is the right partner for me, on the other side. And so, when you think about what does an investment banker do in the process, the way I like to describe it is that there's three fundamental buckets. The first is basically doing a full evaluation of the business, essentially doing the same due diligence a buyer would do to inform themselves about the business so they can adequately sell it and, frame and spin things to their advantage, but also using that as an opportunity to populate things like the data room, which eventually will be needed later in the process. The second aspect is ultimately, running a competitive process. And basically you're using competition to hold people honest and to get the best outcome. Ideally, you can have the buyers, bid, quote unquote, emotionally and really get into a bidding war where it may be priced above, what its true value is. And there's a formal process of going through that. But ultimately you sign what's called the letter of intent with the winner, if you will. And what most people don't realize is that there's about a 50% close rate on the line.
Really? So you think you've crossed the finish line after all this work, and there's still a 50% chance it's not going to happen.
Yeah. And so when you think about it, that's typically, on average, a 90-day period. You think that it's the end. Every client I speak with, thinks that the hard work is done. But the reality is that's when the rubber really meets the road. And so that is a blocking and tackling, unsexy game of project management and making things easy for the buyer to say yes. It seems, trite, but, the reality is that most buyers have alternative uses of their time. And so having stuff which is easy, it's simple, it's documented, making it easy for them to say yes is half the battle in terms of ensuring that something gets over the goal line, as well as basic human communication, like staying, not surprising the buyer and staying continually in touch with them to make sure that if there are issues that you're proactively, addressing it. But part of that is not just managing the buyer, but also managing your client and working with them, because certain things can result in them reacting emotionally. And it's important to be an objective person to help them see things within the broader context. At the end of the day, it's their decision. But for example, it's my role and my responsibility to explain to my client, hey, if we went back to market, every other buyer, I would expect to require the same condition, right? And so there's a lot of different aspects of explaining what's market, what's reasonable, maybe not based upon any prior specific experience with that specific issue, but based upon the totality of experience across a lot of different transactions around, what is reasonable. And so, ultimately that culminates with a transaction. The last thing that I'll bring up that I forgot to mention before, one of the last elements that makes this particularly emotional for a business owner is two things. One, many times they're so busy that they've never really given any true thought to what their life will look like afterwards, right? And so when things start getting really close to the end and start feeling real, there's actually a high incidence of people trying to self-sabotage, because it's a natural defense mechanism of, I'd rather have unhappiness than uncertainty, right? And, the ambiguity bias it's a known bias that exists out there. But the other is that by definition in a transaction and in the negotiations of a transaction, typically between the letter of intent and closing, there will be unanticipated surprises or changes or things that need to be negotiated. People think the negotiations stop at the LOI, but in fact, it's probably hundreds of micro negotiations that will occur in that interim. And if you haven't had the experience of having done it many, many times, you're constantly feeling like, up and down, like this is going to happen and this is not going to happen. And so that continual stress is, a huge challenge for a lot of these, business owners. So while we help with regards to the technical aspects, and, there's plenty of studies that show that being represented by an advisor gets you, 25% more money and higher close rate and all of that. In a lot of ways, just as helpful is going on that emotional journey with the client and helping them both psychologically and educating them on on the process.
Gotcha. Got it. So I'm going to the first stage where you're doing the due diligence. What are some of the things? I might be putting words in your mouth, and this may not exist, but I would think you've done it so many times. You kind of have a checklist of, there are 4 or 5 things that I typically find in that due diligence and that you might be looking for that the owner, business builder should have done differently, or that we're going to have to correct before we can be prepared to initiate the process. Are there such things?
100%. Ultimately, I think it all starts with a strong foundation of, high quality, clean accounting, right? Without a substantiated set of numbers, right, that can be backed up with independent sources like your ERP system or whatnot, you're going to have a tough time successfully selling. You have to remember that, many of the buyers, we talk about a buyer as an abstract entity, but they're employees that work for that private equity firm, right? And then making a stupid decision based on sloppy due diligence will result, if they lose half the value, in them getting fired. So there's always a disproportionate amount of emphasis placed on the risk and the downside risk of something, bad happening. So the first and foremost is having clean financials, because without it, it's very difficult to get very far, at least in terms of getting fair value for your business. Not to say that there's not somebody that wouldn't buy your assets or buy you based on some proxy, but you're going to be significantly discounted than if you did things right, right? So that to me is the first kind of foundational element that you absolutely need. I think the second is to think about what are the deal breakers, right? There are some, going back to my description before, around, nobody wants as a buyer to wake up on Monday morning and half the value has evaporated, right? That's a recipe to getting fired. So what I consider, what I describe as existential threats are essentially really important to focus on. And every industry and business will have different ones. But what I'm talking about is a single action that occurs that could have just a catastrophic impact on the business, even if it's a very low likelihood of happening. What you typically find is most buyers, if they have that catastrophic scenario, even if it's low probability, are going to shy away from it, right? And so ideally identifying what those are, and if you can, addressing them early on is hugely important. So what do I mean by that?
Yeah, what's an example of
the quintessential is customer concentration, right? If you've got all of your eggs within one customer, that's a really scary situation for a buyer, because in particular, if that customer has a deep relationship with you as an individual, when you retire, they may lose that business, right? So that's one example, but there's others. For example, key man risk, right? If the whole business is dependent upon a certain person, that person were to leave, you would have a significantly weak organization is another potential example. And there's derivatives of that as well. So for example, many buyers are reluctant to buy a business that has too many family members within the leadership. Why? Because one person departing or getting fired may result in the departure of a large group and number of people. But there's other examples, whether it's bet the farm litigation that could be so large that it just dwarfs the size of the business. Regulatory investigations, nobody is signing up to be able to then be scrutinized by the government regulators. So there's a number of different areas where it really depends upon the industry. You may have some where it's supplier risk, right, and the ability to get your raw materials to be able to sell. But it's really honing in on that and identifying, are they there? Are there any mitigating factors that we can use? And so we've had many situations, in fact, probably 50% of the time, where we tell people, look, this is not the right time to sell. You need to go work on your business, work on these different things, and let's come back from a position of strength. Because ultimately, there's a lot of different drivers of multiples. But if you want to think about it from a supply-demand standpoint, there are a number of different buyers that are going to, exclude themselves from potentially looking at an investment because they're not comfortable with certain aspects. So the more uncertainties that you can eliminate, you essentially are widening the potential universe of groups that will, look at you. And so that makes you much more marketable and also allows you to get, a higher price.
Because the potential like failure rate or issue rate, they probably apply some kind of higher discount rate or some risk adjustment that you can now diminish by removing these risks or diminishing.
And I think it might have been Daniel Kahneman, but I know it was a Nobel Prize winner that the one based on asymmetric information. And ultimately, you as the seller have a lot more information about your business than the buyer ever will. They can put you through all the due diligence, but they're not going to understand the qualitative and cultural nuances that you know because you live it every day. And what the studies show with that is that buyers overcompensate by essentially assuming the worst case scenario, right? So you need to do everything you can to, to try to eliminate those risks to the extent possible. But if not, compartmentalize or quantify it to show, hey, look, this is not as bad as you might initially think. And so as part of it, it's also our job to try to see how we can reframe things to be, maybe even as a positive, or at least put in a context of which it's not something that becomes, an absolute deal breaker for a buyer.
Yeah, I'd love to talk a little bit more about that reframing, because I'm kind of hearing is there are things that you can do, you can work on the business now to make some things more attractive that investors will be looking at and other things less risky that investors will be looking at. But then there's probably also work in figuring out how to frame the deal or the business so that it shapes how investors will value it. Like if you could talk to that a little bit, like, some businesses are valued based off of customer lifetime value and the potential of a customer. Some are valued off of cash flow. Some are valued off of, people or assets. How do you figure out what the value drivers are or what the frames are that investors would use to judge the value of the business, and how do you shape that?
Yeah, so I would say, look, in the middle market, it's overwhelmingly driven by some type of earnings driven multiple. EBITDA is by far the largest. You do see sometimes as a reference point revenue, but really that's used more for situations of companies or brands that might be subscale, might be unprofitable. And, that's the only real tool. But, quite frankly, since interest rates have increased and the markets have been, much more risk off, there's been a much greater emphasis on not just earnings, but sustainability of those earnings, right? And so, that's one aspect that is really important in due diligence. Every buyer is going to do what's called the quality of earnings, where they'll essentially have their own independent accountant go in and opine on the quality of those earnings. What they mean is, are those revenues sustainable? On one extreme is something like a subscription service with a long-term contract of which for the next few years you're going to be receiving X. And on the other extreme, it's something which is, project-based, discretionary, and, you typically will have booms and busts depending upon, the broader economy and other circumstances. So the quality of earnings, I think, is something which is embedded. That's really important. But, to go to your question around framing, I think a lot of it is around, people, even professional investors, in my opinion, make decisions also emotionally. They say, I like this and I want it, right? And I'm going to buy it within reason in terms of the range, but I'm going to make sure that I get it, right? Particularly, with strategic buyers. And so, a lot of times the way to sell and the way to emotionally kind of hook them is on the narrative side, right? Stories are what connect and really get, humans engaged. And so it depends upon the market and the environment, but a lot of times there's a narrative of which it's considered, common belief that you can attach onto. So let's say I'm working with a manufacturer. It might be, hey, this is essentially a derivative on reshoring manufacturing business back to the United States because we have a broader deglobalization that's occurring. But essentially locking onto something in which somebody kind of intuitively assumes is true, and using that as something which is energizing to propel the conversation. One of the typical things that you see out there is, often tech companies trade at much higher multiples. And so it's not uncommon for a lot of investment bankers and people to say, oh, this is a technology-enabled janitorial business, a technology-enabled HVAC business, whatever it is. And look, WeWork successfully raised money at a high valuation that was multiples higher than a lot of well-established, entrenched people with physical real estate, right? So narratives do matter in these conversations. They don't guarantee that, you're going to end up getting an outsized outcome, but it's almost impossible for you not to, if you are going to, achieve something, well above average.
That's brilliant. Yeah, that makes a lot of sense. Yeah, I remember my wife worked at MasterCard for a long time, and they were viewed as a financial service company, but they changed the narrative to being a technology company about transactions. And now multiples that are applied to that are many times larger, and it's more exciting, and there's more growth expectation. So that's really helpful. I get that you've done this so many times that this is intuitive for you.
Sure.
My next question, you may not immediately have an answer to, but for someone who doesn't have your experience, what is the process that they follow or they can follow to figure out what narrative to use in describing the business?
I mean, I think it starts with, in a lot of ways, your strategic plan and saying, what are the macro trends that are out there that are occurring within the industry, right? What are things that which everybody is universally excited about? And is there a way to tie our story to that? Now, sometimes there's not, right? And that's something that which you say, look, I need to work for a few years and shift my strategy to kind of reverse engineer my way into what I ultimately want to sell in a few years. But, a lot of times there's something that you really can tie into that can help. And the last thing is that it doesn't necessarily have to even be about the business. I personally feel very strongly when, you have some of these, rags to riches entrepreneurs who kind of built something from scratch, them telling that story at the beginning, it sets the right tone, right? It's something that it's inspiring. It connects them with the buyer. Because remember, people are not just, when you buy a company, what are you buying? You're buying people, right? Yes, you're buying the future cash flows, but that's very abstract. What you really are signing up for is you will have these people now reporting to you and working with you as a company. And so that comfort level with the entrepreneur and his integrity, his capabilities, his relentlessness is also something, as well as this whole team, that's really important to the buyer. So to answer your question, I think it's very contextual because, one business in financial services may have a totally different kind of hook. But what it's not is, just putting out, hey, here's leading with the financial numbers. And, this is basically a profit and loss statement. That is not engaging somebody in a in a way that's going to help see the full potential of the business, not just what, has occurred, historically.
Yeah, no, I love what you're saying. I did investment banking early in my career a little bit, but I just got bored with looking at these things as just black boxes that spit out cash flows. And I wanted to get into the stories of the business, the people of the business, why the business matters and why it fits in the world, So it's great that you get to kind of marry those two.
When you think about, sorry for interrupting, but when you think about particularly when you have a management meeting and you have the senior partner at a private equity firm or the decision maker at a big strategic, what are they going to be focusing on? They're going to be focusing on questions that basically go back to foundational strategy things around the sustainable competitive advantage of this business. Why does this business exist? How can it exist with the big, Goliaths? Because at least everybody I'm dealing with are middle market. What is its, value proposition in selling relative to other people? And without having a full understanding of that, I'm not aware of any decision maker that's going to pull the trigger, right? So there's a lot of wrapping your head around what is this business, what does it do, and why is it successful, and providing the insight of showing, not just telling, to me is far more impactful than it just being, hey, here's a bulleted list, and because it commoditizes, right? The reality is that I also want to do right by these business owners, and I want to tell their story, right? I want to tell their full potential, what their vision was, and all of that. And so I feel not only do you get a worse outcome, but you really do a disservice to all the hard work that went into and the sacrifice that they did building those businesses.
Yeah, I love that. I know we're sort of reaching the top of our time with you. I want to get a little bit kind of practical, tactical, although everything that you've shared has been very actionable. Is there a particular business framework or concept that you found particularly useful in either applying it to your firm or applying it to your clients?
Yeah, it's probably not a traditional framework, but I personally have found that the lean startup kind of concept and methodology, which essentially is just saying to iterate quickly, it really resonated with me. And ultimately, when I was at McKinsey, we had the luxury of spending a lot of money and a lot of months of time studying an issue. Most middle market businesses don't have access to that type of data, don't have access to any resources that really could provide a lot of very robust analysis anyways. And what I found is, and I found this in my own experience, running the business, is, in the abstract, you can come up with a business plan and it makes total sense. But when you actually roll it out, the real world may have totally different plans. And it may structurally, it's a totally logical idea, but it's something which has no precedent. And so it's very difficult, for example, like I guess Blue Ocean strategy, it's something of which people really need to be educated to understand it. And it may just be something which is very difficult to span that gap. It could be, data that you think says one thing doesn't, because, there's not any kind of robust data at a very micro level on the ground. And so that concept of iterating and experimenting with little, attempts to kind of prove or disprove foundational concepts, to me was very important, because at least from my personal experience, the number of times I thought I had a bulletproof business plan and then actually went out and saw that it was very different in terms of the outcome, occurred, multiple times. And so many times you can kind of refine and your messaging, for example, let's say, what you're really doing is you're iterating on your marketing message. Maybe eventually you'll get there. But there's other times in which you realize, hey, it's not just a marketing message. I'm swimming upstream, and it's better for me to pivot to something else of which, is compelling and right in front of me.
Yeah, that's great. Yeah, it's interesting. It's almost, I'm hearing kind of two conflicting ideas, or maybe they reconcile. I'm thinking, early on when you're building the business, maybe you should write your business plan and your narrative and pretend that you're selling it now, right? But then you have 5 years or 10 years to actually turn it into creation. And at the same time, you need to pivot and learn and adapt. So maybe you have a plan, but you're constantly redesigning it. Or how do you think of those two things?
I like the way you put it. I think it's a dynamic plan, right? I mean, given the information that you have at that moment, you give your best effort of putting out a plan. And by the way, that's how private equity, in my opinion, the single most important or valuable asset that private equity uses to drive value is essentially reverse engineering. When they buy an investment, they create what's called an investment thesis. They essentially have their future state business in 5 years. They know what it's going to look like. They have an idea of who they're going to sell it to. They have an idea of what they're going to emphasize, what they're selling, and they work backwards and reverse engineer their way and hold themselves accountable to building that business for the ultimate exit, right? And so, but it doesn't mean that when, you get punched in the face that you don't change, because things do happen. Competitors come in, regulations change. And so I think, you always have to have that strategic thinking of where do you think is the best approach, because ultimately you're just trying to allocate your scarce time and resources. But every day you learn additional information, which is changing probabilistically where you think you're going to get the highest ROI of your time and energy. And these experiments, the lean startup, if you will, are essentially giving you data points that are going to help you change some of your, probabilistic thinking.
Love it. I love it. So get a plan, make it a dynamic plan. You have a hypothesis of who's going to buy it 5 years out, and you learn and adapt it as you go. But I guess you always have a plan. Excellent. Love it.
Yeah, and things happen. I mean, if there's one consistent, thing that I've learned is expect the unexpected, right? So, you can't, in my opinion, it's not prudent to build yourself into something where you have a buyer of one, right? Because that buyer could have a bad earnings season. They could, have been bought. There's a lot of things that could be totally independent of you and your success that can impact you, put aside regulations and the rest of the environment. So having that flexibility and optionality is something which you still need to build in. The way that I think about it is you want to shoot for something that has enough, that's generic enough that it could be relevant and applicable to multiple different buyers. Because at the end of the day, whether you're talking about synergy or whatnot, you're only going to capture a large portion if there's multiple buyers that have both the means and interests in buying it, right? If there's only one that can really capture all the value, they have no incentive to overpay to be able to get it. So being cognizant of maximizing the relevant universe of potential buyers is also something I think is pretty relevant, but means that the outcome is not as precise or as specific as it could be if you were saying, hey, look, I'm going to build this for, to get acquired by, big company X.
Yeah. Love it. This has been fascinating. I mean, we could, to try to capture the essence of so many years and so much experience in a little bit of time. This is hard to do, but what you've shared here, I think can save entrepreneurs so much heartache, so much pain, and make them so much more money when they do grow and sell a business. So I want to thank you for taking the time to do that. How else can people continue to learn from you? I know that you write sometimes for Forbes. I believe that you've also published a book. Any advice for someone that wants to continue learning from you?
Sure. So, follow me on LinkedIn, David McCombie. Last week, the book was just launched, published by Wiley, called Selling Your Business with Confidence, a practical playbook for mid-market owners. And, if anybody has any questions or whatnot, I'm always happy to talk and chat. They can ping me on LinkedIn and I'll be quick in responding.
That's awesome. I'm gonna read that book and share with entrepreneurial friends of mine. Thank you, David, so much for being here and for being generous enough to take all this experience and make it accessible to business builders. Thanks for being here.
No, I appreciate it. Thank you.
Thanks.
Thank you for listening to this episode of Strategy at Scale. Thank you to our producer, Oscar Perez, and our teams at Scaling Up, Outthinker, and Growth Institute. If you like what you heard, please follow, download, and subscribe. I'm Kyan Krippendorf. We'll catch you soon with another episode of Strategy at Scale.